Morgan Stanley's Chris Toomey runs one of the highest rated private wealth advisory teams in the country. He joins me here at Post 9. Well, you're consistent. I'll give you that. But why are you still negative? I'm trying to think, you know what, when I knew you were coming up, I'm like, how am I going to handle this interview? I feel like I ask you the same questions every time.
Yeah.
Because I have no choice.
Right.
But, I mean, at some point, as this market, as we just said, is off to its best start in 5 years, you would think that your position would change.
Right.
Why hasn't it?
I think it hasn't because while we have seen tremendous economic growth that we weren't expecting, we've seen inflation come down, we've seen a very strong labor market, the things that we're concerned about continue to be things that we're concerned about. And I think why we're particularly concerned right now and why we think this rally is so remarkable is I think if you look at the pace over this period from October to now, we actually have not even seen a 2% correction. And over that time period, we haven't seen something like that in over 6 years. Mm-hmm. If you look at all of these sectors that are doing well, on a technical basis, they're all either overbought or extremely overbought. So in our mind, I think even on the short term, we would all agree that the market could probably take a breather. So I think from a technical standpoint, from where we have been, I think it wouldn't surprise us to see a pause or, more importantly, probably see a pullback given how far we've moved and how aggressively we've moved.
Okay. That's all fair. And I think you're right in suggesting that nobody would be surprised if there was a pullback, some kind of a correction. I mean, that's what happens in bull markets. However, you were negative. You've been negative since before the market got into the conditions you suggest now make it ripe for a pullback.
So, and let's talk about the underlying thesis behind that, right? So the underlying thesis was the Fed was not going to be as aggressive in cutting rates as the market was pricing. And we saw 2023, instead of rate cuts, we saw rate hikes. We started the year, you talked about this before, instead of getting 7 rate cuts, we're now potentially getting 2, right? And then let's talk about earnings. Earnings last year were flat. Earnings this year, even with the dovish tone and economic growth that we're talking about, are not really going all that much higher. So if you look at the performance, 90% of this performance is PE multiple expansion. And so at that point, are you looking at a situation where the equity market, from an equity risk premium standpoint, is really not giving you that bang for the buck? In our mind, yes, maybe you're right. This is a bull market, but as Roy Newberg said,
it's a bull market, my friend. I mean, the market is telling the story, not me.
Right. Of course. But what is driving that market, right? So even if you go deeper into earnings last year, right, you take out the market cap weighted, you look at equally weighted. Those earnings are negative. If you strip out the Mag 7, earnings are actually down 10%. And you're talking about breadth in the market for this quarter, which you're starting to see particularly in February. Mm-hmm. But if you look at the performance, the 10% performance, 30% of that is one name. Right? So you are starting to get some breadth, particularly with some of the larger names in different parts of the sectors. But the median returns are still around 2 to 3% in each of those sectors.
Okay, let me take a couple points off of what you said, and we'll debate this. Earnings. So we went from an earnings recession, right? We were negative earnings for multiple quarters, and then, as you said, we got flat. But now we're going to grow again. Right. So the trajectory from earnings looks like this, right? We went from negative to flat to now we're expected, as I said, for the first quarter, some 5%. Now, it may be down from what was 10%, but it's nonetheless 5% versus negative. Right. So that's one thing. And then do you really want to be negative on the market into a global cutting cycle? Well, which is what we're going to have. We're going to have that
at some point, right? But let's talk about what are the things that might affect that, right? So growth has done well, right? We saw January, February CPI and PPI numbers that ran hotter, and you can talk about owner equivalent rent and so forth. But I think some of the other things that are a concern are the fact that if you look at gasoline prices, right, which was a tailwind last year, it's up 16% this year. Food prices are up 9%. Consumer sentiment's going down. Concerns with regards to the quit rate
consumer
is
sentiment was good today.
Going down, right?
Wasn't consumer sentiment good today?
Yes. But, look, there's a variety of different consumer sentiment numbers.
But come on, the consumer's been good.
The consumer's good.
The consumer's been strong, and optimism still remains.
It does, but what's going on underneath the scenes, right? You're in a situation where the consumer has got over $1 trillion worth of debt that's paying 20%. Right now, non-mortgage debt is actually equivalent to mortgage debt. So you're basically paying exactly what you were paying before, and savings have come down. So the issue is, for me, is not just the fact that the rates have to come down. If rates stay higher for longer, that's going to be a really problem for a variety of different areas of the economy, and it's not being priced in right now.